guys. Well, today we are going to talk about long-term financial planning, and this is a very important topic because it's a cornerstone of financial management within a company. Within an existing company who is having some operations for a certain number of years. Okay, what is all about this topic? Well, actually, today we are going to learn how we can calculate the external financial needs. The external financial needs are, as their name actually suggests, the external financial needs is the amount of money that the company needs to gather in order to guarantee, the growth rate for sales of the company for the next year. So definitely, the external financial needs could come from actually third parties such as short-term debt, long-term debt, or either equity. Okay. So today we are going to talk about two different methods about calculating the external financial needs. So the points we are going to talk about first is about the importance of financial planning for an existing company. Okay, and the second one is to know the different methods to perform a proper financial planning using actually the concept of external financial needs. So what is a financial planning? Well, financial planning could be seen from two different points of view. From the point of view of an existing company that is operating right now, okay, and actually financial planning makes up to or comes to actually calculate what is the amount of external financial needs that the company needs to gather in order to actually meet his growth rate goal. Okay, and the second point of view in which we could see the financial planning is for a startup. For a company who is not really created right now, but we are planning to create a new company completely. Okay, so the first point of view is the one that we are going to talk about within this presentation, and I will leave the other point of view to another presentation. So in order to actually calculate the external financial needs for a company, for an existing firm, okay, so we are going to talk about the external financial needs using the formula, which is a very quick way to find out what is the external financial needs that a company actually requires, okay, in order to grow at a certain rate for the next year, and the percentage of sales approach. And I will explain actually the difference between the two different methods and what is actually the main problem with these two different approaches, specifically the first one. Then we are going to talk about what is the financial planning for a new company, but as I told you before, I will leave it for another presentation. Anyway, I will give you some words concerning that topic. So let's move on to the first method for estimating the external financial needs. So the first method in order to estimate the external financial needs is the following one. Okay, so we need to understand that the financial balance sheet, the balance sheet of a company could be divided in two different types of accounts. So the first one is the spontaneous accounts, and the second one is the non-spontaneous accounts. Okay, so the spontaneous accounts we are going to represent it by this asterisk star, okay, in the upper part of the letter. So it means that it's spontaneous. What is an spontaneous account? An spontaneous account is an account that will change whenever my level of sales will change. So, for instance, let's suppose that we are working at a 100% capacity, production capacity. So it means that if I'm planning to grow into 15% for the next year, so it means that definitely I need not only more cash, not only more accounts receivables, not only more inventories, but also I will need more machinery and more production capacity. Okay, so the whole amount of assets is going to be spontaneous, just because I need, to make investments in everything, in every account on my balance sheet, on my asset, and in every account of my asset side of my balance sheet, in order to precisely meet my goal for growing for the next year. Okay. Another example. Let's suppose that actually we have production slack. We have some production capacity that we can actually use for producing more okay, products right now. So in this particular situation, definitely we could actually take into account only cash, accounts receivables, and inventories as being the only ones as being spontaneous, okay, and not taking into consideration the fixed assets. Why? Because we have production capacity slack, so we could actually use this part of the slack in order to meet our growth rate goal for the next year, okay. So everything depends or boils down to what is our production capacity. So how much of our production capacity we are using. So depending upon this, we are going to have some spontaneous assets as being only current assets, or spontaneous assets as being completely the full amount of our assets. With respect to liabilities, L in this case stands for liabilities. With respect to liabilities, we can classify liabilities into different types. So we can actually use what is being called operating liabilities and financial liabilities. Whenever it comes to operating liabilities, so operating liabilities are spontaneous. Why spontaneous? Because these are credit for providers, okay? So whenever we are going to planning to sell more, we are going to ask for credit to our current providers, and we are going to get it. Okay, so no more questions asked. What about taxes? Taxes that we have to pay to the government. Should we go to the government, knock the door of the government, and ask him whether we could actually owe the government more taxes in the future? No. The only thing that happens is whenever we actually increase our level of sales, so definitely we are going to owing more taxes to the government. So this is something that we need to understand, that spontaneous liabilities are liabilities that are completely we don't need to go to require them to somebody else, okay. So they are going to increase spontaneously just because our level of sales is going to increase immediately, okay. And as you could see in the formula right away, okay, actually the variation of sales, which is the change in sales divided by sales, okay, the change in sales is what is being implicit in the growth rate in sales. So my spontaneous assets are going to increase as a growth rate in sales, my spontaneous liabilities are going to increase as a spontaneous sales, and the difference between net income and common dividends is what we call my internal sources of funds, okay. I mean, the company is generated an internal sources of funds, okay, which is part of my utilities, of my net income at the end of the year, okay, and this is going to be reinvested. So as you could see right away, what is the external financial needs? The external financial needs is the full amount of my spontaneous assets that I need actually, okay, in order that I need to invest in order to support my growth rate for the next year, minus whatever is spontaneous and I do not need to ask for because it's going to come as my sales will increase or will grow, minus everything that is being called completely internal sources of funds. The difference between these three different factors is what is being called external financial needs, because I could either get it by short-term debt, either by long-term debt, or either by equity, okay, specifically some capital that is being provided by shareholders, okay. Well, actually, this external financial need formula could be represented in an alternative way, which is the last line of the slide, okay. And in order to do so, what we need to do is to actually remember that net income is equal to my expected sales times my profit margin, okay. And dividends is equal to the dividend payout, which is the small d, times the net income. So if we replace these two equivalents in our last formula, so we will see right away that the external financial needs could be expressed as being my spontaneous assets, right, minus my spontaneous liabilities, okay, minus my level of sales times 1 plus the growth rate of sales times the profit margin, and times 1 minus the dividend payout. So when we use actually the first formula or the last formula, well, that depends on the information we have. But these two different formulas are completely equivalent, Okay, so they are equivalent to each other. An example. Okay, let's make an example about how we can calculate the external financial needs for a company. So we have this company, which is Marvel Comics. Okay, so we have actually the total amount of assets. So we have current assets, okay, and fixed assets, and we have liabilities. Out of the liabilities that are being shown in the slide, you could see right away that accounts payable stands for 110 for 1996. So these are spontaneous liabilities. And notes payable stands for 442, and these are non-spontaneous liabilities. These are financial liabilities. Okay. The long-term debt is 440, the common stock 55, and retained earnings is 380. The full amount of total assets is 1,427. Okay. So please pay attention to this. If we have been working, okay, at the full capacity, production capacity, so the total number of assets, which is 1,427, is going to be my full amount of spontaneous assets. But if I'm working with some production capacity slack, so then my full amount of spontaneous assets are going to be equal just to current assets, which in this case is equal to 537. We also are being provided with the income statement for the company for 1996, and out of here we could see that my net sales for that year was 905, okay, and net income is 89. So the question here is the following: if Marvel is projecting a 20% increase in sales and the expenses remain constant as a percentage of sales, assume that depreciation, interest paid, and the firm's tax rate all remain unchanged. So based on 1996 data, what is the Marvel's capital intensity ratio? So the capital intensity ratio is the amount of my spontaneous assets divided by my total sales. So in other words, it says how much capital I need to invest in my company in order to make the sales I'm making. Of course, the smaller the number, the better. In this case, 100 is 1.58. Okay. Now, suppose that Marvel is currently operated at 70% of my capacity. So what is my full capacity sales? So look, if Marvel is working with a slack, with a production slack, because it's working at 7% of full capacity, so we can make a rule of 3. I mean, a very simple rule of 3. So we would say that actually if Marvel is producing $905 million in 1996 with 70% production capacity, how much amount of sales the company is going to produce with 100% of full amount of full capacity production capacity? So the full amount of sales that the company can produce with full capacity production capacity is 1,293. Okay. So let's see. If Marvel is operating at 70% capacity, so what is the external financial needs for the next year? I mean, for 1997. And assuming that the retention ratio is 60%. The retention ratio, okay, is the complementary part of the dividend payout. So for instance, if I'm having $100 as a net income, and my dividend payout is 40%, so I will actually give away $40 to my shareholders as dividends, and I will keep $60 for returning earnings into my company. Okay, so the retention ratio will be 60% and the dividend payout is going to be 40%. So what is my forecasted sales using the 20% growth rate for the next year? As you could see here right away, is 905 times 1.20. I mean, it's 1,086. Because my full capacity sales is 1,293, which is the number we have been calculated in the previous slide. Okay, so definitely it's higher rather than the full capacity sales with the 20% increase in growth rate that I'm expecting. Okay, so definitely I have production slack, and then I could consider only my current assets as being spontaneous. So the change in my current assets times 20%, which is the growth rate, is going to be 107. The change in current liabilities, which is 110 times 0.20, is going to be 22. Remember where the current operating liabilities are coming from, the 110. These are coming from here. You see, 1996, accounts payable, 110. These are spontaneous liabilities. So then the change in retained earnings, how much is going to be? Look, if we assume, okay, that the change in sales is going to impact completely, and in the very same way, okay, the whole operations of the company, so then it will translate, okay, into a retention ratio of $64 million, okay, because it's going to be 89. 89 is the net income of 1996. I increase it by 20%, so that will provide me the net income of 1997. So then I know that the retention ratio will be the same, 60%. So I apply the 60% out of it. So then I have $64 million. If I subtract the change in current assets minus the change in current operating liabilities minus the change in retained earnings, so then I got $21 million. Very important to remember. The formula assumes that the retention ratio stays the same. Any other ratio will stay the same. The depreciation ratio, amortization, everything will stay the same. More than this, okay, it assumes that all the impact into the next year in my profit and loss statement will be exactly the same. So in other words, it's not a realistic assumptions. Okay, so we are not actually assuming realistic assumptions by using the formula, but it provides me actually with a very first shot, okay, of how much money the company will need for the next year, and then we can actually depurate more this figure by using the other method, which is the percentage of sales approach. Now, let's move on to the other extreme case. So let's suppose that the company is working at full capacity. Okay, full capacity sales. So what is the external financial needs for 1997? So actually here, 1,427, it comes from where? From total assets. So look, we have total assets, 1,427. Okay, this is my full capacity sales. Well, not my full capacity sales is actually 1,293, but this is the total amount of assets. And because I am working at 100% production capacity, okay, so definitely the total amount of assets are going to be spontaneous. Because if I have to invest, if I have to sell more, it's because I have to invest also in fixed assets. Okay, so in other words, as you could see, my changing assets, full amount of assets, is going to be $285 million. My addition to actually current liabilities is going to be 22 as before. My addition to retained earnings is going to be 64 as before. So look, my external financial needs will increase to $199 million. So it will go up from 21 to $199 million. What makes the whole world difference is the fact that my fixed assets in the second case is part of my spontaneous assets. Okay. Well, guys, as I told you, now we have to see the percentage of sales approach. Well, the percentage of sales approach is an approach that, as his name is saying, is suggesting, is an approach that is being based upon a percentage of the forecasted sales. Okay, so the main point here is to try to figure it out. What are the external financial needs depending on what is the growth rate in sales that we are aiming to? So let's start with a very simple example. So for instance, as you could see here, okay, so we have growth rate that we are aiming as 30% for the next year, okay, and 1/3 of my net income will be actually distributed as dividends, and 2/3 are going to be distributed as are going to be reinvested into the company as a retained earnings. Okay. The main advantage of the percentage of sales approach above or over the formula that we have just seen is precisely the fact that with the percentage of sales approach, we have the opportunity, okay, of changing a lot of assumptions of the formula. So, for instance, we can change our dividend payout, we can change our profit margin, we can also change many other things, such as if we are going to gather some money in the way of debt, so this debt has to pay some interest, okay, and those interest can be put it again into the income statement in order to calculate the new returned earnings for my project or for my business. Okay, so as you could see here, definitely there are many assumptions that can be changed. Okay, can be changed using the percentage of sales approach. Okay, so as you could see, we started out with a balance sheet in which, okay, according to this balance sheet, we have a full amount of assets, which is $100,000 million. No, it's $1,000 million, and then we have the percentage of sales. Okay, and then with in the right hand side, you could see that the only amount that will increase in 30% is only accounts payable. Whereas in the case of the total assets, okay, the full amount of assets are going to increase in 30% from the size of liabilities. Okay, the only account that will increase in 30% is accounts payable. And why so? Because we will consider notes payable, long-term debt, and social capital as being black accounts. What it means black accounts? I mean accounts that can change depending on our policy as a company. Okay, so how much short-term debt we should gather, how much long-term debt, and how much capital we should gather. Okay, in the way of issuing some stock. About concerning returned earnings by itself, well, concerning returned earnings, well, as I told you, if we gather some debt, we have to actually pay some interest related to this debt, and this debt will diminish our original returned earnings, the one that we already forecasted as being 171 million, assuming that 1/3 is going to be distributed as dividend and 2/3 are going to be loaded back into the company as a retention investment or reinvestment. Okay, so that's the reason why it appears as not available right now. Okay, so let's move on. So for instance, in this case, let's calculate what is going to be the first amount of external financial needs for the company. So first of all, if we are working with full capacity, full production capacity, so the total amount of assets are going to be, or is going to be, definitely my spontaneous assets. So the full amount of assets is going to increase in 30%. So as you could see here, $1,000 million is going to increase in 30% up to $1,300 million. But what about the liability and equity side? As you could see here right away, okay, the only account that will change or will increase in 30% is accounts payable. Notes payable is going to stay the same as long-term debt, social capital, and returned earnings. Okay, this is what is being called the naive step. I mean, the naive step consists in assuming that the company is going to be financed in exactly the same way as it is right now. Okay, if this is true, so the difference between the total amount of assets and the total amount of liabilities plus equity, which is $110 million, is going to be my first estimation of the external financial needs. Now we are in the position to actually impose some restrictions, okay, into the gathering of debt or equity for the company. What restrictions? Well, one possible way of gathering money, I mean the external money we need, is by using what is being called the pecking order theory. So the pecking order theory says that you should gather money first with the cheapest source of fund, then with the second cheapest, and finally with the more expensive source of fund. Okay, so the cheapest source of fund definitely is the short term, then is being followed with long-term debt, and finally you have equity, the issue of equity as being the most expensive source of fund. Okay, if we consider the pecking order theory as a way of gathering money, and if we impose two different restrictions, okay, my financial planning, so then we can calculate the external financial needs. What sort of restrictions we can impose in my financial planning? Well, actually, in this case, we are imposing two different restrictions. The first one is that the current ratio cannot fall too, and secondly, that the total debt ratio, which is short-term debt plus long-term debt over or divided by total assets, must not be above 40%. Okay? So let's look how things are going to end up. So first of all, okay, I will impose my first restriction. So the first restriction is that the current ratio, which is current assets divided by current liabilities, okay, cannot be below 2. So this implies a maximum of 234 amount of current liabilities, okay? Since right now I'm borrowing 218 as a current liability, so the extra current liability that I can actually gather is $16 million. With respect to the long-term debt, it's pretty much the same. I mean, 40% of $1,300 is about $520 million. This is the maximum long-term debt I could have. Okay? Since right now I'm gathering, okay, not only long-term debt, but it's a long-term debt and short-term debt, debt in general. Since right now I'm having 234 millions as a short-term debt, so the extra long-term debt maximum that I can gather is $286 million. But right now, as a long-term debt as it is, I'm gathering $200 million. So the extra long-term debt, okay, that I can gather is $86 million. Okay, so in total, I could gather in short-term debt or in long-term debt as an extra, I can gather $102 million. So the external financial needs that I need is $8.4 million that necessarily I have to gather it by using by issuing some equity. Okay, so this is the optimal way in which I should gather money. I mean, $16 million in short term, $86 million in the long term, and $8.4 million as capital. As you could see, a possible plan could be $8 million as a short-term debt, $43 million as a long-term debt, and $59 million as capital. Okay, which in total is $110.4 million. Hey Sam, why we didn't follow up actually the 16, 86, and 8.4 as we stated before? Because one thing is what is the optimal way of gathering money, and another issue is what can I do in reality. Okay, if I go to the bank, actually, if I manage to try to bargain for a certain short-term debt, long-term debt, that depends how much money I can gather. Okay, I could aim for $16 million, but perhaps in the short term I could only gather $8 million by a bargaining process. All right, so how the balance sheet would look like? Well, considering that the whole amount of assets will increase in 30%, so that will go up from $1,000 million into $1,300 million. And with respect to my liability sides and equity, well, accounts payable will increase in 30%, notes payable will increase in $8 million, long-term debt in $43 million, and social capital in $59.4 million. What about return on earnings? Here we are assuming that the gathering of $8 million and $43 million as short-term and long-term debt is of no cost. So that's the reason why my return on earnings will increase in just 30%, which is 171.6%. Okay, $171.6 million. But as we know, in reality, okay, every time that you gather money, short-term, long-term, will cost you. If that is the case, so we need to follow a second feedback in which we will reduce the return on earnings, rendering the total liabilities plus equity a smaller amount rather than the total assets, and rendering a new amount of external financial needs that we need to add it up to the first one, and we need to figure it out how we can gather this extra amount with the short term, what part in the long term, what part with equity issuing, Okay, we need to figure it out that. In this case, just to keep it simple, okay, I'm assuming that the company can gather this extra amount of money, short-term and long-term, 8,043,000,000 at no cost. So at the end, we matched. I mean, the balance sheet is fits, okay, in $1,300,000,000, and that's it. So let me make what is being called a static comparison, okay, of another scenario for the same company. So far, we have been assuming that the full capacity sales has been 100% production sales. Okay, I mean that the company is working at 100% production capacity. If the company is working at 80% production capacity instead of 100, so what would have been the full capacity sales? It would have been $2,500,000,000. But at full capacity, okay, what will be the proportion? I mean the capital intensity ratio that the company will need. Well, 640, which was the original amount of fixed assets, divided by the 2,500. So at full capacity, the company will use 25.6 or 25.6% of fixed assets in order to actually yield $2,500,000,000 as sales. Okay. If we will consider a 30% increase in sales, given the fact that right now the company is having $2,000,000,000 as sales forecasted for the next year, so the new amount of sales will end up in $2,600,000,000. Assuming that the fraction of the fixed assets is going to be proportional to that, so the company will need $665.6 million as fixed assets in order to deliver a total amount of sales of $2,600,000,000, which is far below the 832, as you could see here, $1,000,000, okay, that we have been forecasted, okay, previously with 100% production capacity. So my savings, just given the fact that I'm having a production capacity slack of 20%, okay, my savings in fixed assets is going to be $166.4 million, which, if I subtracted it from the original external financial needs, that will imply a savings of $56 million. So I don't need to gather extra money in order to actually achieve a growth rate of 30%, provided that I'm going to use my 20% production capacity slack completely in order to produce, okay, $2,600,000,000 as sales for the next year. Well, guys, as you could see, the percentage of sales approach is an approach that is completely flexible. Flexible because it allows us to definitely overcome many of the assumptions of the formula. Okay, although the formula can give me a very quick approximation of my external financial needs, I would rather say that you are not going to be sure what is the full amount of your external financial needs until you actually apply the percentage of sales approach. I hope that this capsule is going to be useful for you as an introduction to the topic. Thank you very much for your attention, and see you in the next one.